Hi, my name is Jay, and I make finance videos. And the purpose of today's video is going to be looking at what a mutual fund is, why it is an incredibly important investment for the average investor, and hopefully breaking down some different selection criteria that you can use to then go invest yourself and help educate you in general about mutual funds. So, starting off, I should probably explain right away why mutual funds are so important as an investment. And even before that, actually getting into what a mutual fund actually is. So, a mutual fund is a form of investment that is made up of a bunch of different smaller investments. And that may seem strange at first. Why would an investment be made up of other different investments? But the purpose of a mutual fund is to allow a small to medium-sized investor to get a high level of diversity in their portfolio. So, what's diversity? Well, diversity essentially is how spread out you are across a number of different areas when it comes to investing. It means you're invested in a bunch of different regions. It means you might be invested in a bunch of different industries, companies, and there's a lot of variety in the things that you own. The reason diversity is good when it comes to investing is because it lowers your risk. When you are highly diversified, when you're spread out across a number of different things, when bad things happen in the market, say a company goes bankrupt, something with an industry goes wrong where there's just a negative effect, a region goes into a downturn, you're protected. It helps lower the risk that's associated with you because when you're spread out, individual bad effects, individual bad sort of market issues are lowered. Their effect is lowered when you're spread out across a number of different areas. So diversity is typically good because it lowers that risk, and it's something most investors should strive for. And essentially what a mutual fund does is it allows you to have access to a high level of diversity pretty quickly, and pretty simply rather. And I'm actually going to throw it over to an illustration to help show that point. So what is a mutual fund? Essentially, a mutual fund, as I mentioned before, is an investment made up of smaller different investments. And what they are is essentially a middleman between a bunch of small investors and those investments themselves. So the mutual fund, being the middleman, takes the money of a bunch of small-time investors who normally would not have access to a high level of diversity. It takes that money, pools it all together in one, and then goes and invests that. And invests in things like stocks, it invests in bonds, and other types of investments like real estate and a variety of different things. And essentially the mutual fund is that middleman that allows the small-time investor to have access to a high level of diversity at a very low cost. They allow you to achieve that without a bunch of fees and a variety of different things, and that's the power of a mutual fund. It is a middleman that allows you to achieve diversity. And it is going to be the investment for most average investors. Now, you might be wondering, why do you actually need the mutual fund to achieve that high level of diversity? Why can't you, the investor, just go out and buy a bunch of different stocks, bonds, and different things to get that diversity yourself? Why do you need to go through a middleman? Typically, when you think of middlemen, it's people that raise up the price. You think, it's often better just to go to the original seller instead of going to the store that's buying it from someone else, marking it up, and middlemen are often considered or thought of as bad things. The issue is when it comes to investing, if you are directly buying stocks and bonds, there are fees associated with that. There is something called a brokerage fee where you have to pay for that if you want to buy the stock. And brokerage fees can range anywhere between $5 to $30 in the sort of upper end when it comes to actually making that purchase. And the issue is, let's say that you wanted to go out and buy into 100 different companies. You wanted to buy 100 different companies' stocks to get that high level of diversification. And let's say your brokerage fee is $10. Well, that's $1,000 in fees just to get a high level of diversification. And that might be achievable for someone who has millions upon millions of dollars. Then it would become a fairly small thing. But if you're like most people and say only investing anywhere between $10,000 to even $100,000, you can't pay those kind of fees. It just eats away at your money. And that is where mutual funds come in. Now, there is a small fee associated with mutual funds that they charge to actually manage that money, but that is entirely reasonable because they're providing you a very valuable service in allowing you to get that diversification without paying those significant brokerage fees. And that's why mutual funds are really important. Now, if it hasn't sort of keyed in what mutual funds are exactly, I'm going to do another diagram right now just to hopefully break it down a little bit further. So, when you have a mutual fund, it is broken into a number of smaller different investments. And a way to conceptualize it is by thinking about it like a pie chart. And so in this instance, the mutual fund is represented by the pie chart, and it's going to have a variety of different things that make up it. And in this instance, it's going to have things like resource collection, being the tree there, real estate, utilities like water and electricity, technology, and agriculture. And so in this instance, this mutual fund would be broken into 5 different specific regions industries that it is invested in. And the reason this is important and it protects you as an investor is that if something, say, bad happened in the resource sector where there was a huge fallout and a lot of their companies lost value, you would be protected to a degree because you're spread out across 4 other different regions. And that's the power of diversification and mutual funds. It protects you against specific events in specific regions or industries that are negative and have the potential to hurt you as an investor. It lowers your risk overall. So hopefully I've gotten across the point that mutual funds are pretty powerful and they're pretty important for most medium to small investors because they just provide diversification so simply and typically fairly cheaply, in that mutual funds can typically be bought anywhere between $10 to $30. So they allow you to get that diversification at a fairly low cost. Now, the next thing that we really need to talk about is the difference between index mutual funds and managed mutual funds. Now, an index mutual fund essentially means that nobody's actually picking stocks and moving things around. Nobody's actively managing it. It is a mutual fund that is designed to mirror or copy a certain index. So if you've ever heard something like the NASDAQ or the TSX, that is a stock exchange. And an index fund for the NASDAQ would own a proportional amount of all the different stocks that are actually in the NASDAQ. It's designed to copy and mirror what's going on in the NASDAQ, and it's just specifically essentially designed to mirror that and mirror its returns. Now, managed funds, as you might guess, is where someone actually is going in and choosing which stocks to buy, which bonds to sell, and moving things around actively. Now, the key difference between these two things is that managed funds are going to have a higher fee associated with them. You're going to have to pay more money for them. And the important thing to understand as an investor is that there is no, over the long term, tangible benefit with going with a managed fund over an index fund. The reality is that index funds almost universally outperform managed funds over the long term. And what that means is when nobody is picking the stocks, when they're just designed to mirror a stock exchange, when they're just passively copying a certain index or a certain exchange, they do better than when somebody is picking the actual individual stocks. That's a really important thing to understand. And the reason that in most cases you're going to want to choose index funds is because, again, they have those lower fees associated with them. So you're going to pay less fees over time, and it's going to be a benefit for you. And it's really important to understand that. And there are managed funds that have outperformed indexes in the past consistently, but they are incredibly rare. And even in the likelihood of you finding and choosing one is very low. And just to put this into perspective, one of the most illustrious and successful investors of all time was Warren Buffett. And he ran a managed fund that consistently beat the markets. And he himself advises that the average investor invests in index funds. He himself, a person who consistently beat the markets as a fund manager, recommends that most people invest in index funds. And the reason for that is because it is very rare that you actually find a fund manager who can consistently beat the markets over the long term. So you should be prioritizing index funds when you can find them. So that's an important thing to look for when you are selecting mutual funds. Second thing that's really important to understand is the difference between a mutual fund and an ETF. And an ETF is essentially an exchange traded fund. And that means that it is a mutual fund that is traded on stock exchanges. You buy and sell it just like you would buy a stock. And as I mentioned before with stocks, there's a brokerage fee to buy them. Same thing with an ETF. There is a fee associated with buying into an ETF on a stock exchange. And the benefit, or the major benefit of an ETF, is because it's on a stock exchange, there's a wide variety of them. There's thousands out there that you can buy from. And so there's a lot of variety in what you have access to. But you do have to pay that initial fee to buy into it. And that is sort of the drawback and benefit of ETFs. There's a wide variety out there on the stock market, but you have to pay an initial fee when you make that purchase. So typically ETFs are good if you have a lot of money to initially invest. If you say have $10,000 or more dollars and you want to buy into an ETF, well, that 5 to 10, maybe a little bit more depending on where you're actually buying through. That's a small amount when it comes to $10,000. And so you can take that money and buying it through a stock exchange is fairly valid. And because you have that high level of choices to choose from, that can be a pretty big benefit for you. But if you're someone who's investing a lot of consistent small amounts. Let's say you're setting aside $100 each month. An ETF doesn't really make sense for you initially. And what you're going to want to do is actually go look at whatever financial institution you do business with. And typically they have mutual funds that you can purchase in through their company. And almost all institutions will have systems in place where you can buy a mutual fund consistently, set up a plan where you're, say, putting in $100 each month, and they won't charge you fees for that. And so you're going to have to go through a financial institution to do that. So ETFs are great if you have a lot of money to invest initially, and then mutual funds through whatever bank or financial institution you go through is better if you're investing small, consistent amounts each time. But what we're going to do now is actually look at two different examples, one through BlackRock, which is a major provider of ETFs, and another through TD Canada Trust, which is a financial institution primarily in Canada, but expanding around the world now, and look at two different mutual funds offered by either one of them. One is an ETF, one is a mutual fund, and break down some of the information that will be relevant in selecting mutual funds so that you know a little bit more when you go out to actually choose your own mutual fund. So now we're going to take a look at two different mutual funds offered by two different companies, one being BlackRock and one being TD Canada Trust, just to see the kind of information that is provided on the website so that you have a better idea when choosing and selecting your mutual funds, what to look out for, what information is relevant, and what doesn't matter as much. So we're going to start off with the BlackRock mutual fund, and this is an ETF. So remember, an ETF is an exchange-traded fund, and it essentially means that it is bought and sold exactly like a stock. You can buy it through a brokerage account, and the information that's relevant for that is that when you do buy and sell it, you do have to pay a brokerage fee. So there's an expense to buy and sell ETFs, and that can range anywhere between $5 to $20 typically. And so almost always ETFs are better if you're investing a large lump sum of money. If you're investing, say, small amounts like $25 a month, they don't really make sense. So looking at this is offered by BlackRock, and BlackRock and Vanguard are probably the two best companies that offer ETFs out there. So if you're looking to invest in ETFs, I would check out either BlackRock or Vanguard. They have a wide selection, pretty high quality, low MERs. I personally invest through BlackRock, but I would say Vanguard is just as good. So the first piece of information that is relevant is the stock ticker symbol, so this XIU. That essentially is the identifier that you would need to know if you were going to buy it. It is how you would search it for it on a brokerage to actually buy these stocks. So that's just its identifier. The name being the 60 index ETF. This essentially means that it is 60 of the largest companies on the TSX, and that is what the index is trying to mirror. Remember, an index is a mutual fund that essentially is not managed. It has an objective or a goal that is set out initially when it's created, and it is passively managed where things are occasionally adjusted to stay in line with that, but essentially it is an unmanaged mutual fund. Now, looking at some of the other information we have here, it costs $24.45 to buy a single share in this mutual fund. This 52-week is essentially the high and low for what the cost would be. So over the last 52-week period, the lowest cost for this mutual fund was $22.05, highest being $24.50. So that just gives you a range on what it has costed, what it has been to buy a share over the last 52 weeks. This is the one-day performance, so it's been up 0.85%. Year-to-date return, essentially meaning how well it has performed this year. So green arrow upwards, it's done 1.92%. It's been up for the year so far. The overview is essentially a little bit of information about this fund. It is primarily large, well-established Canadian companies, and it almost is entirely focused in equity. Equity meaning it is company ownership. It owns stocks. And equity is a little bit more volatile than, say, bonds, so you're going to see higher fluctuations. This is a fairly large ETF in Canada, started in 1990. This is kind of nice because we'll be able to look at some historical performance for the fund and sort of see that. It's not the end of the world if a mutual fund has only been around for a little while, but if it's been around for longer, you can look at historical performances, and that is useful for figuring out the volatility you might see in a mutual fund. The investment objective, essentially the goal that the mutual fund is trying to mirror or achieve, and typically every mutual fund has a specific goal. So seeking long-term capital growth. Essentially, this is going to be a mutual fund that you want to invest in for a longer period of time to see those returns. It's something that you want to put money in for 10 or more years, probably. So now let's go look at the performance section. Now here is where you will see your total returns as a percentage over the past 1, 3, 5, 10, and then inception being since it was started, and this one started in 1990, so it's been around 28 years. Now, something you want to be really careful with when looking at mutual funds is, and they actually mention it here, and if you look at the last sentence there, past performance does not guarantee future results. This is a very common mistake when people are looking at investing in mutual funds. They will look at this 7.9% and say, okay, this is what it's achieved every year for the past 28 years. Well, I can expect it to return 7% over the next 3 years upcoming. That's a very dangerous thing to do. Past performance does not guarantee future performance. Do not expect this is not a guarantee. Don't expect 100% to get 7%. It could be higher, it could be lower. Just understand that. And especially in this case, because this is primarily focused on Canadian equity, if you're at all familiar with the Canadian economy as of June 2018, it's not doing so hot, and almost certainly you will not see a 7% return over the next 2 to 3 years. So keep that in mind. Past performance is not a guarantee of future performance. One thing, though, that is useful when looking at when we have sort of a lot of term data, this is actually a graph of sort of historical performance of the mutual fund. So this is 1 year. What we're going to do is we're going to look at all. And what's really nice about this is you can actually look at specific historical events in the past. So if you remember 2007, that was right around the mortgage crash. So you see right before the mortgage crash, this mutual fund, if you had invested $10,000 at the start in 1990, would have appreciated to $25,625. That's pretty good. But if you look at what happened after the mutual fund crash, after the fall off, the low point was right around $13,000. And so it's important to understand this is a fairly high volatility mutual fund, because during the mortgage crash of 2008, this fund lost half of its value. Now, as you can see, eventually it did come back in the following years, 2011. It essentially had reached its previous value, and it continued on forward until now. But again, this has a lot of highs and lows, and that's really important to understand. If you're investing in this mutual fund or a mutual fund like this with high levels of equity, you will see a lot of volatility during, say, market crashes. You're going to see a lot of value fall off. And that value would probably come back later on when the market does eventually return, but you're going to see a lot of highs and a lot of low points. And that's important to understand. There's a lot of risk involved in mutual funds that are heavy in equity, and you're going to see a lot of highs and lows. So that is a really great part of past historical performance. But again, be very careful about looking at past returns and then using that as a guarantee for future returns. So, key facts. Most of this isn't super relevant, but we'll sort of go through and explain what they mean anyways. Net assets essentially means how much is managed by this mutual fund. As you can see, it is a very large mutual fund. It's one of the biggest out there. It has a lot of value held in it. And if you remember back to how mutual funds work, essentially this is the pooled assets of all the investors, and that is what mutual fund is then investing in various different companies to give you that easy diversification at the cost of just $24 per share. Toronto Stock Exchange is essentially where it's traded. The benchmark index is what the index funds are trying to mirror a certain exchange or group of companies. This is trying to mirror 60 companies in Canada, some of the largest ones. Fiscal ending period, not super relevant. Units in standing essentially means how many shares there are. The asset class is equity. This is pretty relevant. Remember, equity is high volatility. You're going to see high lows and high highs and low lows. You're going to see a lot of volatility, a lot of swings up and down. And there's a lot more risk associated with equity. But over the long term, say over 10, 15, 20 years, you will see higher returns on average for equity mutual funds. And what we're actually going to do when we go look at the TD Canada Trust mutual fund, we're actually going to look at a bond fund. And what you'll see is bonds are more secure in the sense that they're stable. They're going to have less highs and less lows. But over the long term, they will offer lower returns. They're less risky, but they provide less return. So that's really important to understand. Equity is higher risk, but also higher returns over the long term typically. Inception date being when this mutual fund was created, 1999. Oh, I thought it was 1990. The index provider, Standard & Poor's, not super relevant. And price, we saw that at the top already. Oh, actually, let's go back and look at portfolio characteristics. So most of this stuff is not going to be super relevant if you're not too familiar with investing. Things like PB ratio, PE ratio, these are things that are typically useful when determining the valuation of stocks. It's a common sort of ways for investors to know the value of stocks. When looking at a well-balanced mutual fund invested in, say, 60 of the biggest companies in Canada, you don't really need to worry about these too much, especially if you're new to investing. If you ever decide to, say, get into stock investing, you're going to want to know what PE ratio and things like that mean. But if you're in a well-balanced mutual fund, it's not really super relevant to you. When looking at management fees, this is one of the most important things you want to look at and understand when selecting a mutual fund. Over the long term, management fees have a huge effect on the value you make out of an investment. The higher the management fees, the less money you will make. And it is a huge difference, just say between 0.05% will have a significant effect on your returns over a 50-year period, let's say. So you want to have low management expense ratios, MER. That's what you want to look for. And whenever you're investing in an index fund, you're going to have some of the lowest MERs out there. So 0.18% is incredibly low, or it's a very good MER. Anything when you're looking at BlackRock or Vanguard, you're typically going to see anywhere between 0.05 and 0.5%. And anything in that range is pretty good. So 0.18%, that's good. Anything above 0.5 to 1%, it's okay, but you're starting to get a little bit more expensive if you're investing in index funds. Anything above 1% is pretty high, and so anything between 1 to 2 is okay only if you're looking for something very specific. If you're looking for a mutual fund that is not very common, that's very focused in a specific area, maybe it's reasonable to have a 1.1 to 2% MER, but really you want to target anything between 0.05 and 0.5%. So 0.18 is pretty good. And then anything above 2% is incredibly high, and you should not be investing in any mutual fund with that high an MER. Again, a high MER will have a very negative effect on your overall return over the long term. It has an incredibly significant effect, so always target the lowest possible. The next thing, the sort of a very important piece of information, is your risk rating. This essentially means how risky this mutual fund is, the highs, the lows, what kind of fluctuations you might see. As I mentioned before, this is a primarily equity mutual fund, so it has medium risk, and that means you can see some pretty high highs and pretty low lows. If you had a mutual fund that was, say, invested in India or emerging markets, you might have a risk rating of high, and bonds will typically see low to medium risk ratings. Now, when it comes to risk rating, there are ways to sort of determine what you are comfortable with as an investor when it comes to risk. There are risk rating quizzes that are often offered by financial institutions. You can do a quick search for investing risk rating quiz, and it will give you sort of an idea of what you might be comfortable with. They're not, in my opinion, the greatest or most accurate when it comes to actually determining your risk. And really the best way to figure out what you are comfortable with is apply how you deal with risk in real life, or how comfortable you are with risk in real life, to your investing strategy. When faced with risk, do you embrace it? Is it something that you're comfortable with in real life? Then sort of choosing a medium to medium high might be okay. If you're not comfortable with risk at all, if you don't deal well with it, you want to focus on low to medium. So things like bonds. It's very important that you accurately and appropriately assess how comfortable you are with risk and choosing something that matches it. You don't want to invest in high risk. If you get nervous whenever you're doing something risky, don't invest in high. It will not end well for you. You want to map to something you're comfortable with when it comes to risk. And if you are unsure, always lean on going on the safe side. So start with low to medium if you're not sure. And because you're investing probably for a long period of time, you'll be able to adjust that as you figure it out. So these are two of the most important pieces of information when selecting mutual funds. MER, you want lower, is always better. And risk rating, you want to make sure that you map whatever risk is associated with the mutual fund to whatever you're comfortable with. The next piece of information you can look at is the holdings. This essentially means what kind of companies are held within this mutual fund. And remember, this is equity in some of the largest companies in Canada. So Royal Bank, Toronto Dominion, it's a lot of financial institutions that are held here. And you can see Suncor, they deal with, I believe, primarily oil, exploration, Enbridge, gas. And you can see sort of the information. So the Royal Bank represents about 8.5%, and so on and so forth. And if we scroll down a little bit more, you see the exposures and breakdowns. This essentially is by industry what percent is in the mutual fund. So almost 40% of this mutual fund is actually in the financial industry. And this can be relevant if you're somewhat familiar or you follow what's going on in the markets. And the reason that is if you know, say, the financial market is going to have some issues, say going forward, or if you have some information or you know something about the tech industry, knowing the breakdown can be relevant, but this is more if you are familiar or following the markets and industries and knowing what is going to happen. But if you're relatively new to investing and you're not 100% sure about various pieces of information, the things you want to focus on are where the mutual fund is. So this is a Canadian mutual fund, and sort of is that a place you want to invest in? The second thing is you want a low MER. You want something that matches with your risk. Those are the main things. The rest of the information, you can definitely shop around, look at different things, and I highly encourage you look at a variety of different investments before actually investing, but those are the primary pieces of information you really want to focus in. And the rest of the things can help you with decision making, but those are the things that should be your priority when selecting. Risk rating, MER, where it's being invested. You can look at things like exposure breakdowns, but those are the relevant things. So that is sort of the ETF for BlackRock. Now we're going to go take a look at TD Canada Trust. They are a financial institution in Canada, so a bank. And one of the main reasons or benefits of investing in a bank over a mutual fund is that you can typically set up plans where you can invest small amounts of money each month into a mutual fund without having to pay any fees. So remember, when you're investing in ETFs, you have a lot of a wider variety. Almost always you're going to have a lower MER, but you also have to pay that brokerage fee when you initially invest, anywhere between $5 to $20. And that can add up if you're only, say, investing $100 a month. So typically, if you're investing small amounts of money every month, you're going to want to go through your financial institution. So go see what they have. Most banks will have a variety of offerings when it comes to mutual funds. And TD actually does have their own E-Series. So E-Series represents index funds. You see here Investor and Premium. Those are managed funds. And managed funds have a lot higher sort of expenses. That MER is a lot higher, and they almost always provide the same or lower returns than index funds over a long period of time. Index funds almost always outperform managed funds over a long period of time. So really, almost always you should be investing in index funds. Pretty much, unless you have a very specific reason for not investing in. And just to put this into perspective, because there are occasionally, rarely managed funds that do outperform indexes over the long period of time. And one of the most famous examples is Warren Buffett. And Warren Buffett is a very successful investor who did consistently beat the markets. And again, he's very rare, and something very important to understand is Warren Buffett himself recommends that most people invest in index funds. It is very unlikely you will find a managed fund that does better than index funds. So it's very high risk to get a low reward. So you want to focus on index funds. That's just stick with index funds. It will almost always do better for you. Now, what we want to do, we're going to actually look at a fixed income in this case, because last time we looked at an equity that was focused on stocks. So now we want to look at something that is focused on bonds. So this is a bond index fund, and we're just going to open it up and look at the information here. As you can see, it's a little bit of a different layout because it is a different site. So the price is $11.43 for a single share of this mutual fund. The bond index, so you see the word index, that means it's not managed actively. It is focused on copying or mirroring an index and sticking with that. And as you'll see, it has a lower MER because of that. The objective is to maximize total return through interest. And essentially what that means is it's focusing on low risk, steady income investments. You're not going to see high returns, but it's going to be fairly stable. Main reason you want to invest in here is passive exposure, meaning that you won't see a lot of risk. It's going to be fairly stable, steady growth over time. So looking at historical performances, again, don't use historical performances as a guarantee for future returns. Inception, it's been around 5%. So if you remember back to the equity, it was 7 point something percent, I believe. So equity will almost always return higher over the long term, but you will see way more stable returns through a bond fund typically. So you're going to see, so if you remember the equity graph from the iShares one, it was a lot of highs and lows, ups and downs, up and downs. When you look at a bond fund, it might be something a lot more steady where it slowly appreciates over time. And that's what you're going to see. And that's why this has a lot lower risk rate here. Anything that is bond related will almost always be a low, stable growth kind of mutual fund. You can get high risk bonds, but typically you're not going to see it in anything with a low risk rating. This is the index that essentially this mutual fund is trying to mirror, not super relevant. Again, this is how much is actually invested in this mutual fund. And then this is once again, one of those really important pieces of information, your MER. Now remember, 0.5% is somewhat near the higher end, but because this is offered through a financial institution, it is going to be a higher MER. That's just a reality of investing. ETFs have the lowest MERs out there, index ETFs rather, through BlackRock and Vanguard. But again, you have to pay that brokerage fee. So it's great for one-time or large sum investments. But when it comes to consistently investing a little bit each month, you're typically only going to, or it's efficient to go through a financial institution to do that. And the reason being is this has a pre-authorized purchase plan, where you can set aside $25 or more each month, and they'll allow you to do that without paying fees. And that's one of the benefits of going through a financial institution. This is very common with mutual funds through a financial institution. If you're pulling your money out right after buying into it, they will charge you a small fee, very common. Minimum investment, subsequent investment, that's for one time, and pretty reasonable, pretty standard. Asset mix here, what we have is the breakdown of what essentially is in this mutual fund, and it is all bonds. So it is all those lower risk, steady growth, interest earning investments. And as you can see, the top holdings, they're all primarily government bonds and provincial and federal government bonds, and it is all focused in Canada. So that essentially breaks down the information they provide here, and all the sites are going to be a little bit different, but remember, the key things you want to look for when selecting a mutual fund: the risk rating, and does the risk rating match up with what you are comfortable with? So if you don't deal well with risk, this is going to be a better mutual fund for you than the equity one because it has low risk. You're not going to see a lot of fluctuation, ups and downs. It's going to be fairly steady. The next thing you really want to look for is your MER. So anything between 0.05 and 0.5% is good. Anything above that, unless you have a very good reason for investing in that mutual fund, you probably want to avoid it. You always want to look for the word index. Index means that it is unmanaged and it passively mirrors a certain index, and that's good because it almost always outperforms managed funds in the long term, and you pay way less when it comes to MER. So you want to target index mutual funds, and then you also typically will want to look where this mutual fund is based. So if you want to invest in the States, you would invest in a mutual fund primarily based in the States. If you want to invest in a place like Canada, you do a mutual fund. So you look at the region. You can look at industry and breakdown and things like that to do sort of a final decision between what mutual fund you want to invest in. But typically when you're looking at a place or like a financial institution like TD, they don't have a wide variety. If you remember, there was actually only one bond index fund out there. So it's a lot easier to choose between them when you're going through a place like TD because there's not as many options and it's fairly simple for you to do. But again, MER, risk rating, the region, you can look at industry breakdowns. You can look at historical performances to get an idea of the fluctuations, but don't look at it as a guarantee for future returns. It is a little bit more complicated when you're going through a place like BlackRock because they do have a wider variety of investments out there that you can choose from, but that should be a significant amount of the information you'll need to actually choose and select some mutual funds. And then just periodically over time, sort of check in on your investments, look at what's going on, and make adjustments based on that. But that is the relevant information you'll need to know to select mutual funds. So hopefully this video has helped you understand a little bit more about what mutual funds are and a little bit more about the information you should know and should be selecting your decisions off. Again, focusing highly on making sure that your mutual funds fit what you're comfortable with when it comes to risk, and lower MER is better. And then a variety of other things that we talked about that you can also help in choosing your selection criteria for choosing what mutual fund you eventually want to invest in. Now, it's important to understand that as you grow and continue on with your life, you'll get better understanding of investing, and your situation might also change too. So it's important to revisit your choices when it comes to mutual funds, when it comes to all forms of investments over time, and consistently update those to reflect your new situations. But again, hopefully this has helped a lot with your selection, and good luck.